Welcome back to Talk Tickers. This is the deep dive where we strip away the fluff.
All the PR spin.
Exactly. Ignore the PR spin and get right down to the raw numbers that actually move the markets. We are looking at the tickers that are talking. And today, the volume is loud.
Very loud.
And the signal is incredibly interesting. I am your host and joined as always by my co-host and resident expert to break it all down for you. Today, we are turning our eyes north. We are looking at the Canadian energy giant Cenovus Energy, ticker symbol CVE.
It is great to be here. And you are right. The signal on Cenovus is fascinating right now.
Yeah.
It is, this isn't just another quarterly report from an oil major.
Right.
If you look at the Q4 2025 earnings call we just analyzed, this feels like a graduation ceremony.
A graduation ceremony. That is a bold way to start.
Well, it is true.
Usually when we talk about oil companies, we were talking about flow rates and crack spreads, not, diplomas. What exactly are they graduating from?
They are graduating from the big kid table to the true heavyweight champion table. For years, Cenovus has been a large Canadian player. Sure, they were significant.
Very significant.
But this quarter, this is the transformation quarter, they have effectively transitioned into a global heavy oil superpower. They have finally digested that massive mega energy acquisition. They have cleaned up the portfolio by selling off the WRB refining joint venture, and they are now sitting on a portfolio that is knocking on the door of producing 1 million barrels a day.
1 million barrels a day. Let's pause on that for a second.
It is a massive number.
That is a psychological threshold that puts you in a very, very different weight class. That isn't just a Canadian story anymore. That is a global energy security story.
Exactly. And the market seems to agree with that assessment. We saw the stock pop about 2.8% intraday.
Trading right around that 23.15 mark.
Right. So the street liked what they heard. They are buying the narrative that the transformation is complete.
They did like it. And that is notable because, let's be honest, if you just glance at the balance sheet without context, it looks a little messy right now.
Messy is a polite word for it.
Well, net debt is up significantly. Usually when a company adds billions in debt in a single quarter, investors get nervous.
They usually run for the hills.
Right. They start asking questions about leverage ratios and interest coverage. But here, the stock went up. Why is Cenovus getting a pass?
Context is everything. The market looked right past that leverage bump because the operational machine, the actual engines pulling the oil out of the ground and refining it, are running at record efficiency.
So they're ignoring the debt.
They are willing to forgive the debt temporarily because the cash flow story is so compelling. They see the debt not as a problem, but as the tuition fee for that graduation we just talked about.
Right.
They borrowed money to buy growth, and the market believes that growth is going to pay for itself very quickly.
Okay, so here is our mission for this deep dive.
Yeah.
We're going to unpack exactly how Cenovus beat the street's expectations despite a revenue miss.
Which is a fun anomaly to talk about.
Absolutely. We are going to get into the weeds of this MEG energy integration because that is where the real alpha is hiding. We have to talk about the downstream miracle.
How they made money when refining margins were tanking elsewhere.
Yes, exactly. And we're going to look at the weather war happening in the Atlantic Ocean right now.
And of course, we have to talk about the China extension.
The sleeper hit.
That is the sleeper hit of the quarter that almost no one is talking about, but the value implications are massive.
Absolutely. And if you are listening, you will want to stick around until the very end because we have this is not financial advice segment that involves potholes and asphalt that you're not going to want to miss.
It is an outrageous trade pitch.
It really is. But let's start at the top. The headline numbers give us the snapshot.
The headline is the beat, pure and simple. JAP net earnings came in at $934 million.
Wow.
That translates to a diluted EPS earnings per share of 50 cents. Now, to put that in context, the consensus on the street was looking for somewhere around 39 cents.
So that is a massive beat. We were talking roughly a 28% surprise on the upside.
Huge.
In a market where algorithms trade on a penny difference, a 28% beat is a grand slam.
It is. And in this market, a 28% beat on earnings is hard to ignore. But the number that really matters for the long-term bulls, the number that the institutional guys are circling in red ink, is the cash flow.
Always comes down to cash.
Always. Adjusted funds flow is a massive $2.67 billion. That is $1.46 per share of cash generated in a single quarter.
That is the engine right there. $2.67 billion in funds flow. If you annualize that, you are looking at over $10 billion a year in cash generation.
Which buys a lot of forgiveness for other issues.
Like that debt load we mentioned. What about the production side?
Total upstream production hit 918,000 BOE per day. That is barrels of oil equivalent.
Right.
But here is the kicker, and this is what management dropped in the call that really got people excited. The exit rate.
The December number. Because the acquisition closed mid-quarter, the average is a bit messy, right?
Right. The average for the quarter was 918,000. But in December, as they were exiting the year, production was over 970,000 BOE per day.
970,000. They really are knocking on the door of the 1 million club.
Yeah.
That is incredible scale.
Over.
But I have to play devil's advocate here. I was looking at the revenue line.
Ah, the revenue miss.
Yes, revenue came in around $10.88 billion. That was actually a miss. It missed consensus by about $5 million. Why did the market completely ignore that?
That is a classic rookie mistake when looking at integrated oil majors. In this sector, top-line revenue is a vanity metric.
Vanity metric. Explain that.
It fluctuates wildly based on the underlying commodity price. Whether oil is at $70 or $80 changes revenue drastically, but it doesn't necessarily change profitability if your costs are managed well.
Right.
What investors care about is the margin capture and the cash flow.
So it's about how much you keep, not how much you ring at the register.
Exactly. A $5 million miss on an $11 billion revenue line is a rounding error. It is noise. The signal is the 50-cent EPS and the massive cash flow.
Okay, fair enough. Revenues, vanity cash flow is sanity. But let's talk about the tension I mentioned earlier. The balance sheet. You said it was messy. I am looking at net debt. It ballooned to $8.3 billion.
Yep.
That is up significantly quarter over quarter.
It is up, but let's look at why. It is almost entirely due to closing the MEG Energy deal. That had about a $3 billion impact on the balance sheet.
Which is a big chunk of change.
It is. Now, that was partly offset because they sold the WRB refining joint venture and got about $1.9 billion for that. But net, they took on leverage to buy growth.
So the market sees this as good debt.
Precisely. It is strategic debt. They bought a massive asset that is immediately accretive to cash flow.
Okay.
The market is looking at that $2.67 billion in quarterly cash flow and doing the math. They're saying, okay, you owe $8.3 billion, but you are printing cash so fast that you can pay that down to your target of $4 billion relatively quickly.
If the operational engine was sputtering, that debt load would be scary.
Exactly. But because the operations are humming, the debt looks manageable.
It is a bet on execution. They are saying, we believe you can pay this off because you are running the business well.
Correct. And that brings us to the core of the execution story, the upstream juggernaut. This is where the rubber meets the road, or the shovel meets the sand, I guess.
Let's dive into that, because the oil sands numbers were staggering. 727,000 BOE per day from the oil sands alone. That is a record.
It is a record, and it completely validates the acquisition strategy. We have to talk about MEG Energy. This deal closed in mid-November.
So it was just a partial quarter.
Right. So in this Q4 report, we are only seeing a partial contribution, about 6 weeks or so. But even with just that partial contribution, it added over 100,000 barrels per day of top-tier production.
And strictly for you listening who might not follow Canadian geography, this isn't just buying random barrels in a different zip code. This is about location, right?
Location is everything in the oil sands. The MEG assets sit right inside Cenovus's existing Christina Lake area. Imagine you own a massive ranch.
Okay, I am picturing a ranch.
And your neighbor owns a smaller, really high-quality ranch right in the middle of your land. And you finally buy them out.
You can take down the fences.
Literally and metaphorically. This is what they call the boundary lands. Now that Cenovus owns both sides of the fence, they can optimize the reservoir management where the leases touch.
Why couldn't they do that before?
Before you had to leave a buffer zone, you couldn't drill right up to the edge because of legal and technical reasons. You don't want your steam affecting their oil or vice versa.
Right. That makes sense.
Now you can drill the whole thing. That is trapped oil that is suddenly unlocked just by signing a piece of paper.
That is fascinating. It's technical synergy. We always hear about corporate synergies.
Firing the HR department and merging the accounting teams.
Exactly. And they are doing that right.
Oh, absolutely. Management is already claiming victory there. They are very confident in hitting $150 million in annual synergies for 2026 and 2027.
Which is nice.
That is the low-hanging fruit, consolidating offices, cutting duplicate software licenses, that sort of thing. But they see a path to over $400 million by 2028, and that bigger number that comes from the engineering.
Explain that. How do you get $400 million in savings just by being better engineers?
It comes down to well design. Cenovus has pioneered a specific way of drilling SAGI wells, steam-assisted gravity drainage.
Right.
They use wider spacing between the wells, and they drill the wells longer horizontally.
So fewer wells to get the same amount of oil.
Exactly. And
Yeah.
fewer wells means less steel, less cement, less surface footprint, and less steam injection. They are now taking that Cenovus playbook and applying it to the MEG assets immediately.
Wow. So they're wasting no time.
None at all. They announced a 42-well redevelopment program kicking off right now on the legacy MEG lands using Cenovus designs. That drives the cost per barrel down significantly.
So they are basically upgrading the operating system of the assets they just bought.
That is a perfect analogy. They bought the hardware, the reservoirs, and now they are installing Cenovus OS to make it run faster and cheaper. And the efficiency gains are exponential when you apply them across that much acreage.
Let's look at the legacy assets, because Foster Creek and Christina Lake, the original crown jewels, they didn't just sit still while all this M&A was happening.
No, they didn't. Foster Creek hit a record 220,000 barrels per day. And this is interesting because this is a mature asset. Usually mature assets decline.
They deplete over time.
Right, but they delivered an optimization project adding 30,000 barrels a day ahead of schedule.
And Christina Lake.
Averaged 309,000 barrels per day. And there is a small technical note here that I think is really important for the people who really want to understand the margin expansion.
Lay it on us.
They mentioned an enhanced sulfur recovery project coming mid-year.
Okay, enhanced sulfur recovery sounds the most boring thing imaginable. Why should you or I care?
It sounds boring, but it cuts operating expenses, OPEX, by 50 to 75 cents per barrel.
50 to 75 cents per barrel.
When you are producing 300,000 barrels a day, saving 75 cents on, every single one of them adds up to massive pure margin expansion.
It is a lot of loose change.
It goes straight to the bottom line. It's not sexy, but it makes them incredibly resilient to low oil prices.
It is the difference between making money at $40 oil and losing money. It lowers the break even.
Exactly. And speaking of resilience, we have to look at Sunrise. This is an asset that used to be a bit of a headache for them years ago.
I remember that.
Now it has gone 2 full years without a safety incident, despite high activity. Production is up to 60,000 barrels a day. But the big news here is the maintenance schedule.
I saw that in the transcript. They're moving to a 5-year turnaround cycle. It used to be 4 years.
This is huge. A turnaround is when you shut the whole plant down, take everything apart, clean it, fix it, and put it back together.
Sounds expensive.
It costs millions of dollars, and you produce zero oil while it is happening. Moving from a 4-year cycle to a 5-year cycle means you have an entire extra year of full production and zero maintenance cost over that period.
Just a free year of cash flow, basically.
They have no major shutdowns scheduled at Sunrise until 2030.
That is a clear runway for cash generation. They basically just cleared the calendar for the next 4 years to just print money at Sunrise.
And that is what investors want to see. Stability, predictability. It turns a volatile asset into a bond-like instrument.
Before we leave the upstream, I want to touch on the science corner. You mentioned solvent technology earlier. Spruce Lake North. They're spending $250 million. What are they actually doing there?
This is the future of the oil sands. Traditionally, you inject steam to melt the bitumen so it can flow.
Right, SEGI.
But making steam requires burning natural gas, which costs money and creates carbon emissions. The solvent technology, specifically at Spruce Lake North, involves injecting a mix of steam and condensate.
Condensate. Basically a light hydrocarbon liquid.
Think of it like paint thinner for oil. The condensate helps dissolve the bitumen chemically, while the steam melts it thermally.
Oh, I see.
The result is you need much less steam to get the same amount of oil. It lowers the steam-to-oil ratio, or SOR.
So you burn less gas, you emit less carbon, and you get more oil.
Correct. It increases recovery rates and lowers carbon intensity. It's getting more output for less energy input. And if they can prove this works at scale at Spruce Lake, they can roll it out across the entire portfolio.
That could be massive.
It could structurally lower the cost base of the entire company for the next 20 years.
So that is the upstream. Record production, massive integration, and new tech. But frankly, the part of this earnings call that really caught my attention was the downstream. The refining business.
The downstream anomaly.
Anomaly is the right word. Because if you look at the broader market refining crack, spreads, the profit margin for turning crude into gas and diesel, they tanked in December. Everyone was hurting.
The Chicago crack spread was particularly ugly.
And yet Cenovus comes out and says their adjusted market capture was 95%.
95%. That is shockingly high. In a bad market, you usually see that number dip into the 60s or 70s.
How is that possible? If the market is paying peanuts for gasoline, how are they capturing 95% of the theoretical margin?
This is where the integrated model shines, and it's where their specific asset configuration pays off. There are three main reasons they pulled this off. First, the heavy crude advantage.
Walk us through that.
Cenovus refineries are complex. They are built to chew up heavy, sour crude oil, the stuff that comes out of the oil sands. In Q4, the WCS Western Canadian Select differential was wide.
Meaning it was cheap.
Canadian oil was selling at a $14 to $15 discount to WTI.
So the upstream side of the business was hurting a bit because they were selling their oil cheap.
Right. But the downstream side, the refineries were buying that same oil, so their feedstock costs plummeted. They were buying raw materials at a massive discount compared to a refinery that has to buy light sweet crude.
Right, so cheap ingredients, that helps. But what about the product side? Gasoline prices were trash.
Gasoline was trash, but diesel and jet fuel were strong. Because they have operational control, they tweaked the yield.
Tweak the yield, like turning a dial.
They adjusted the dials in the refinery to minimize gasoline production and maximize diesel and jet fuel. They shifted the mix to where the money was.
Pivot to quality. I like it.
And then there's the third factor, the asphalt factor.
Asphalt. The black stuff on the roads.
This is a niche insight that a lot of generalist investors miss. Asphalt margins were surprisingly strong in Q4.
Really? In the winter?
Cenovus, especially at their Superior refinery, has a specific configuration that produces a lot of asphalt. So while standard gas refiners were losing money on every gallon of unleaded they sold, Cenovus was quietly making a killing selling asphalt.
They are basically a construction materials company disguised as an oil company in Q4.
In a way, yes. And finally, logistics. They mentioned the Toledo dock. They set records moving volume over the dock.
Why does that matter?
This allowed them to bypass the local Chicago market, which was flooded and cheap, and send their product to other markets where prices were higher.
That is the definition of optionality.
Yeah.
You just send it where the check is biggest?
It proves the thesis of the integrated model. When the upstream takes a hit on wide differentials selling cheap oil, the downstream prints money by buying that cheap oil. It is a natural hedge.
And Q4 was the perfect stress test for that hedge, and it passed with flying colors.
Absolutely.
Okay, let's move from the refineries in the Midwest to the wild North Atlantic. We need to talk about the weather war.
This was the most dramatic part of the call. West White Rose. This is their next big growth wedge, a massive offshore platform off the coast of Newfoundland.
Management was incredibly candid about the struggle out there. They called it an abnormally severe winter storm season.
That is putting it mildly. They described 17-meter waves.
Yeah, I tried to visualize that. 17 meters. That is a 5-story building. Imagine being on a platform in the middle of the ocean and seeing a 5-story building of water coming at you.
And winds hitting 170 kilometers per hour. That is hurricane force. You simply cannot work in those conditions.
I would assume not.
You can't run cranes. You can't move supplies. It halts everything.
So given that nature is trying to destroy them, what is the timeline?
They are still guiding for first oil in Q2 2026, but management admitted it is tight.
Tight.
They explicitly said they hope to be drilling by now, but they are still in the commissioning phase.
Tight in CEO speak usually means we are sweating bullets.
It does. But they did share some progress. The living quarters are open.
That sounds trivial, but it's huge, right?
It's massive. It means the workers are sleeping on the platform itself, not on a flotel vessel next to it.
A flotel, like a floating hotel.
Exactly. When you have 17-meter waves, you can't transfer people from a boat to the platform safely. If they are already sleeping on the platform, they can keep working on the inside stuff, wiring testing, even when the storm is raging outside.
So they are hunkered down.
And main power generators are running. Welding and coating of the legs is complete. They are close.
What is the risk reward here? If they miss Q2 and it slips to Q3, does it matter?
It pushes cash flow to the right, which is annoying for the spreadsheets. But the prize is worth the wait. Once West White Rose is on, it produces light oil that sells at Brent pricing, premium pricing.
Right.
And it has very low operating costs once it's built. It's a high-margin cash machine. They just have to beat the weather to turn the key.
So the Atlantic is the battlefield. Let's zoom out to the macro picture. Egress, getting the oil out of Canada, has been the Achilles heel of this industry for a decade. What is the landscape now?
It has completely changed. Trans Mountain TMX is working. It is flowing oil to the West Coast. The volatility in differentials has calmed down because of it.
Thank goodness for that.
But what was interesting on the call was the forward-looking commentary. Management hinted at new projects.
New pipelines. I thought we were done building pipelines.
Not quite. The analyst community brought up Enbridge's potential projects, MLO1, MLO2, MLO3, and potential reversals of Bakken pipelines. And Cenovus's stance was very telling.
What did they say?
They said they're seeing more viable pipeline proposals now than in the last decade.
That is a sea change in sentiment. 10 years of gridlock and now suddenly options.
And they said they are ready to sign long-term contracts to support them. That is a signal to the midstream companies, build it, and we will pay you. They are aggressive on securing future capacity.
Now, I want to talk about something that gets very little headlines, but seems to be a gold mine, the China gas surprise.
The Asian business, the unsung hero. Cenovus has a partnership with CNOOC in the South China Sea, the Luan 3-1 and Lulua 29-1 gas fields.
And they announced an extension.
Sales agreements extended to 2034 and 2040.
What is the value of that paper? It sounds like just some dates.
Management quantified it. They said this adds $2 billion in incremental free cash flow over the life of the field.
$2 billion. That's not pocket change.
And you have to understand the economics of this gas. It is fixed price gas. It doesn't fluctuate like Henry Hub in North America. It's a guaranteed price.
So no volatility.
None. Plus, they get liquids upside.
Hey.
And the operating costs are ridiculously low, around $1 per McFef.
So it's a cash machine that requires very little maintenance capital. You just collect the checks.
Exactly. It just sits there and prints money, and they just extended the license to print for another decade. It provides a stable baseline of cash flow that offsets the volatility of the oil sands.
Let's bring it all back to the shareholder. Show me the money. What are they doing with all this cash?
In Q4, they returned $1.1 billion. That was split between $714 million in buybacks and $380 million in dividends.
They are leaning heavy on the buybacks. I like that.
They are. And they clarified the framework. Right now, because of the debt from the MEG deal, they are allocating 50% of excess free cash to debt reduction and 50% to shareholders.
And what is the trigger to get more to the shareholders?
The goal is to get net debt down to $4 billion. But there is an intermediate step. Once net debt hits $6 billion, the returns bump to 75% to shareholders.
So as the debt falls, the buybacks rise. It is a mechanical staircase.
That is the algorithm, and management was very firm on their philosophy. They do not chase commodity prices.
Meaning what exactly?
They said if oil rips to $80 or falls to $50, their capital program, which is around 4.7 to 5.0 billion, stays the same. They are disciplined. They aren't going to go on a spending spree just because oil spikes.
That discipline is key. It's what got them out of the hole in 2020, and it's what is driving the stock now.
Absolutely. It is a boring strategy, but it works. Keep costs flat, let revenue rise with oil prices, and funnel the difference to the shareholders.
So to recap, we have massive earnings beat. We have a transformation quarter with the MEG integration. We have a downstream business that is defying gravity with 95% market capture. We have a weather battle in the Atlantic that they seem to be winning, albeit slowly. And we have a hidden gem in China printing billions.
And a clear path to paying down the debt and ramping up buybacks. It is a very constructive setup.
Which brings us to my favorite part of the deep dive. We have looked at the data, we have parsed the transcript, and now it is time to get a little creative. It is time for our special segment.
This is not financial advice.
That is right. This segment is for entertainment purposes only. Do not do this. Do not sue us. We are just two voices in your headphones breaking down sources. But if we were running a hedge fund and we had to pitch an outrageous trade to the investment committee based solely on this earnings call, what would it be?
I have got one. And it comes directly from the weather war and the asphalt anomaly we discussed.
Oh, I cannot wait. Let's hear it.
I call this the pothole spread. Or if you want to be fancy, long asphalt, short the commute.
Long asphalt, short the commute. Walk me through the logic.
Okay, connect the dots. Point one, we heard on the call that gasoline cracks are dying. Why? Maybe efficiency, maybe EVs, maybe people just aren't driving as much. But gasoline is weak.
Okay, that's logic.
But point two, we heard Cenovus say asphalt is saving the quarter. Margins are strong.
Right, so the Superior Refinery is pumping it out.
Point three, management described severe winter storms and 17-meter waves in the Atlantic. And we know the Midwest and Northeast have been hammered by winter weather, too.
I see where you're going with this. The weather is a catalyst.
What happens when severe winter storms meet roads? Water freezes, expands, and cracks the pavement. Then a truck hits it. Potholes. Massive car-swallowing potholes.
Winter storms destroy roads.
Yeah.
Destroyed roads meet asphalt.
Exactly. The severe weather is a leading indicator for asphalt demand in Q2 and Q3. The worse the weather now, the more paving needs to happen in the spring.
So Cenovus isn't just an oil company. In this trade, Cenovus is an infrastructure play. They are a road repair company.
Precisely. So the trade is you go long Cenovus because they are secretly an asphalt powerhouse disguised as an oil major. They are the supplier of the cure for the potholes.
And the short side. What are we shorting?
You short a pure play gasoline refiner, let's say a generic Gulf Coast refiner that doesn't have the asphalt capacity. Or if you want to get really exotic, you short the road user.
Short the road user. How do you do that?
Short the auto insurance companies. Because 17-meter waves in the Atlantic metaphorically translate to 17-inch deep potholes in Chicago. That means blown tires, bent rims, and suspension damage. Claims are going up.
I love it. You buy the guy selling the patch and you sell the guy paying for the damage. The pothole spread.
It's the perfect spring trade. The waves tell you everything you need to know about the roads.
There you have it. The pothole spread. Do not trade it, but definitely think about it next time you hit a bump on the highway.
And remember, Cenovus is making money on that bump.
That is a wrap for this deep dive into Cenovus Energy's Q4 2025. It is a beast of a quarter. Record production, the MEG integration is real, the downstream is resilient, and the debt is coming down.
The only thing standing between them and a perfect execution year is the weather in the Atlantic. Watch that Q2 startup date for West White Rose. That is the next catalyst.
And for all of you listening right now, here's a final thought to mull over. We talk all about Cenovus optimizing their own assets. But if they just proved they can wring $400 million in technical synergies out of a neighbor's acreage just by taking down the fence, how many other fences are out there in the Canadian oil sands just waiting for a smart buyer to knock them down? Think about that consolidation game. We will be watching. Thanks for taking this deep dive with us. Keep your eyes on the ticker. See you next time.